You check your phone. A headline proclaims that the Federal Reserve has issued a statement. You skim the article, most people would. It seems dull, it seems uneventful. Yet that innocuous-looking page has just quietly determined the value of your home, the rate of return on your savings, your likelihood of being laid off, even the price of the groceries in your next trip to the market. What people don't realize is that the statement, for all its tedium, contains crucial clues about how the central planners want you to think about your own finances. Every word in that document has been selected with care to influence the thinking of millions of people who will never actually bother to read it. Spend more, spend less, pay down debt, take on more debt. The Federal Reserve doesn't have the power to dictate those choices directly, but it can shape the environment in which such decisions are made. And for once, it seems to have taken a particularly radical approach. So you read the statement closely. You read every word. There are 5 things that stand out in the document that make it clear this really was a different kind of statement than what came before. The first difference is simply one of length. This statement was unusually brief, containing barely more than 100 words. This was the shortest such statement since the arrival of new Federal Reserve Governor Kevin Warsh at the helm of the central bank. Unlike his predecessor Ben Bernanke, whose statements always carried a certain amount of forward guidance, Warsh didn't believe in telegraphing his intentions. "We will give you the facts as best we can judge it," he said in his commentary on the statement, a formulation that makes many people wonder just what he thinks he should have said instead. The short statement suggests that the Fed is willing to take a more hands-off approach to managing the economy by reducing the amount of guidance it traditionally gave to markets about its plans and intentions. Why would the Federal Reserve want to do that? A glance at the second and third things that stand out in the statement suggests that perhaps not all of the clues are contained explicitly within it. What jumps out at you reading this particular statement is exactly what isn't said in it. The text of the statement reflects almost exclusively one of the 2 core missions of the Federal Reserve, the maintenance of stable prices within the economy. Less emphasized is the other component of the Fed's mandate, the maximization of employment. Milton Friedman famously asserted that inflation was always and everywhere a monetary phenomenon, that it always reflected a failure of monetary policy, and hence should be dealt with exclusively by the central bank. A shift in emphasis toward prices over jobs suggests that the Fed has internalized this view and is willing to accept a deterioration in labor market conditions if it allows the Fed to maintain price stability. The Federal Reserve is stating very clearly where its priorities lie, and a lack of emphasis on jobs in the statement is an indicator of where its real priorities may be. The third thing that stands out about this document is the rate itself. The federal funds rate was left virtually unchanged, hovering just above the middle of the 3% range. It is a tacit admission that the central bank is running out of traditional tools to deal with inflation, since moving rates further into the 3% range would cause borrowing costs to rise dramatically, at a time when the central bank would rather stimulate the economy. Markets were already pricing in a decrease in the federal funds rate, and in effect what the Fed signaled was a pause, with an eye toward tightening before the end of the year. What this means to you is that your credit card rates, your mortgage payments, and the interest due on your variable rate loans are unlikely to see any decreases in the near future. The fourth thing that stands out in this particular statement is the reason for inflation. The document cites supply factors, particularly in the form of energy prices, as the primary cause of the increase. The document specifically mentions geopolitical tensions in the Middle East as contributing to prices in that region, which is an indicator that the Fed is considering a supply-side explanation for inflation. There are 2 broad conceptualizations for inflation within economics. The first one, associated with John Maynard Keynes, holds that demand drives inflation, and that there are limits to how much an economy can produce at any given time. When demand temporarily exceeds supply, prices rise overall until a new equilibrium is established. The other perspective on inflation is that it is primarily a supply-side phenomenon, driven by disruptions to production and the limited ability of producers to respond to increased demand in the short term. The Federal Reserve statement points to supply as the reason for inflation, and that suggests that the central bank expects prices to continue rising until supply catches up to demand. The tools normally used by the Fed to reduce inflation, increasing interest rates, would have little effect on supply bottlenecks, which may be a critical consideration in assessing how the economy is likely to fare in the near future. Have you ever wondered why rising prices refuse to relent, even when the central bank says that it is doing everything it can to stop inflation? The fifth thing that stands out in this statement is the reaction to it. Traders were quick to label it moderately hawkish, a characterization that has implications for you as well. Hawkish monetary policy has a direct impact on long-term interest rates, even if the federal funds rate is not explicitly mentioned in the statement. This is because markets tend to react immediately to perceived changes in policy by adjusting the forward rates on long-term bonds. Long-term rates dropped after the release of this particular statement, flattening the yield curve dramatically. A flattening yield curve is often associated with economic slowdowns, as long-term rates fail to exceed short-term rates normally expected from the federal funds rate. Again, this speaks to the perception that the Fed is willing to tighten monetary policy to deal with inflation. This kind of change may affect your ability to borrow money further into the future, as the market begins to perceive increased risk. Even if the Fed does not move quickly to reduce inflation, the market's reaction to this particular document has already begun to have implications for your personal finances. Now here's where all of this connects directly to you. All of this theoretical discussion about inflation and forward rates eventually comes down to your paycheck, or rather its absence. Richard Thaler, one of the pioneers of modern behavioral economics, has argued that people are actually much less sensitive to broad macroeconomic trends, such as inflation, that appear to have a direct impact on their finances. In reality, people are much more concerned about absolute changes in prices as compared to what they are used to, rather than the generalized increases that economists attempt to quantify with inflation statistics. The reason why people are so concerned about inflation is because the prices of the things they buy seem to be rising much more quickly than they would expect. That is effectively what the statement from the Federal Reserve is acknowledging when it cites energy prices as one of the sources of inflation, as it implicitly accepts responsibility for the rise in consumer prices. What the document fails to say is that this is actually a tacit admission that inflation is much more pervasive than what the central bank actually believes it to be. The general public is much more aware of the day-to-day prices of the things they buy, while macroeconomic indicators such as the CPI or the PPI represent averages that mask a much wider range of individual experiences. Inflation as measured by the CPI has continued to accelerate through a period in which the Federal Reserve has consistently insisted that it has kept inflation under control. That is also the context in which the first statement on inflation from the new Federal Reserve Chair needs to be viewed. The problems of inflation in the late 70s and early 80s were much more acute than what the economy is currently experiencing today. At the same time, the Federal Reserve under Paul Volcker was much more willing to tolerate a recession to reduce inflation, and it took several brutal years of unemployment before the Fed could claim victory over inflation. The crisis of 2008 has made economists much more reluctant to allow a recession to occur, even as they recognize its value in curbing inflation. Every Fed chair since has had to balance these two competing imperatives, attempting to avoid doing too much or too little at any given time. The mistakes of the past always seem to be the ones that a new governor is most likely to repeat at the beginning of his tenure. Which mistakes do you think are more likely to occur during the first year of Warsh's leadership? Here's the thing that you should actually be most concerned about with this particular document. This was Kevin Warsh's first statement in his capacity as the new Federal Reserve Chair. First impressions are always important, but they also set the expectations for the years to come. People will be comparing every subsequent statement to this one, trying to decide if this really is an indication of what the new governor intends to do in his time in office. Short statements, an emphasis on hawkish measures to reduce inflation, and an unwillingness to address the concerns about job creation are all indications that the Fed has chosen to take a much more interventionist stance in managing the economy. Benjamin Graham, the father of value investing and the mentor to Warren Buffett, once said that in the short run, the market is a voting booth, but that in the long run, it's a weighing machine. The markets are voting on the ideas expressed in this document, and over the next few years, the true value of these policies will begin to emerge in the changes in hiring rates, the amount of economic activity, defaults on loans, and other key indicators. What does that mean to you? It means that you don't need to be a trader to take advantage of this situation. You just need to understand it. You need to understand that variable rate borrowing costs are unlikely to change for the better in the near future. And you need to understand that prices in certain categories are unlikely to decrease. Regardless of what the Federal Reserve says about prices in general, you need to understand that less transparency from the Fed means that you need to be more informed about monetary policy if you wish to make wise investments. And you need to understand that the next time you hear about a new statement from the Federal Reserve, you should probably actually read it. Because here's the thing that people fail to realize when they look at a Federal Reserve statement. It is not actually written for economists. It is written for you. You check your phone. A headline says that the Federal Reserve has issued a statement. This time, you don't scroll right past it.